Dividend investing can be a powerful way to generate passive income and build wealth over the long term. Here are 10 tips for unlocking the power of dividends and making $1,000 a month. Choose stocks with a high dividend yield. Look for stocks that pay a high percentage of their earnings as dividends. Typically, these are companies that have a history of stable earnings and are less likely to cut their dividend payouts. Choosing stocks with a high dividend yield is a popular strategy for dividend investors. The dividend yield is calculated by dividing the annual dividend payment by the stock price. A high dividend yield can indicate that a company is financially healthy and generating consistent profits, and that it is returning some of those profits to shareholders in the form of dividends. However, it's important to keep in mind that a high dividend yield isn't always a good thing. A company may offer a high dividend yield because its stock price has fallen, which could be a warning sign that the company is struggling. It's important to do your due diligence and evaluate a company's financial health and earnings growth potential before investing solely based on its dividend yield. Invest in blue chip stocks. Blue chip stocks are large, well-established companies with a track record of consistent earnings and dividend payments. These stocks tend to be less volatile than smaller, riskier stocks. Investing in blue chip stocks can be a great way to build a solid portfolio that can withstand market volatility over the long term. Blue chip stocks are shares in large, well-established companies with a long history of stable earnings and a proven track record of success. These companies are often leaders in their industries and have a strong competitive advantage, which can help to protect them from market downturns. Blue chip stocks typically offer lower risk and higher stability than smaller or riskier stocks, making them a popular choice for conservative investors looking to generate steady returns. While blue chip stocks may not offer the same high growth potential as smaller, more volatile stocks, they can provide a reliable source of income and help to diversify a portfolio. As with any investment, it's important to do your research and consider factors such as the company's financial health, management team, and future growth potential before making an investment decision. Additionally, consider your own risk tolerance and investment goals when diversifying your portfolio. A more conservative investor may prefer a portfolio with a higher allocation of bonds and fixed income assets, while a more aggressive investor may be comfortable with a higher allocation of stocks and growth-oriented investments. By diversifying your portfolio, you can create a well-balanced investment strategy that aligns with your personal goals and risk tolerance. Reinvest your dividends. Rather than taking your dividends as cash, consider reinvesting them back into the stock to purchase more shares. This can help compound your returns over time. Reinvesting your dividends is a powerful way to maximize the returns on your investment portfolio over the long term. Rather than taking your dividend payouts as cash, reinvesting them back into the stock can help to compound your returns over time. This means that your investment gains can generate additional gains, which can snowball into significant returns over the long term. By reinvesting your dividends, you can also take advantage of dollar cost averaging, which involves purchasing more shares at regular intervals regardless of market fluctuations. This can help to smooth out your investment returns and reduce the impact of market volatility on your portfolio. Reinvesting your dividends can be a great way to grow your wealth over time, and it's a strategy that is often recommended for long-term investors who are focused on building wealth through their investments. Monitor your investments regularly. Keep an eye on the performance of your investments and make adjustments as needed. This may involve selling underperforming stocks or increasing your holdings in stocks that are doing well. Monitoring your investments regularly is an important part of being a successful investor. By keeping a close eye on your portfolio, you can identify any potential problems or opportunities for growth and make informed decisions about buying, selling, or holding your investments. Regular monitoring can also help you to stay on track with your investment goals and adjust your strategy as needed based on changes in the market or your personal financial situation. Additionally, monitoring your investments can help you to avoid emotional decision-making and make rational, data-driven choices about your portfolio. While it's important not to obsess over short-term fluctuations in the market, regular monitoring can help you to stay informed and make adjustments that can have a significant impact on your long-term investment returns. Overall, monitoring your investments is a critical component of successful investing and can help you to achieve your financial goals over time. Don't chase yield. Avoid investing in stocks solely based on their high dividend yield. High yields can be a warning sign that the company is struggling, and its dividend may not be sustainable over the long term. Don't chase the product is an important principle for investors to remember when selecting investments. Chasing after hot stocks or trends can lead to a portfolio that is overly concentrated in a particular area or asset class, which can expose investors to unnecessary risk. It's important to do your research and make informed decisions about your investments based on your own unique circumstances and objectives, rather than simply following the latest trend. By staying focused on your own investment strategy and avoiding the temptation to chase after hot products, you can build a well-diversified portfolio that is better positioned to achieve your long-term financial goals. Consider dividend-paying ETFs. Exchange-traded funds, ETFs, can provide exposure to a diversified portfolio of dividend-paying stocks. This can be a good option for investors who want to take a more passive approach to dividend investing. Dividend-paying ETFs can be a great way to gain exposure to a diversified portfolio of high-yield stocks while also minimizing risk. ETFs, or exchange-traded funds, are collections of securities that are traded on an exchange like a stock. Dividend-paying ETFs invest in a range of stocks that offer high dividend yields, which can provide a reliable source of income for investors. By investing in an ETF, investors can gain exposure to a broad range of stocks across different sectors and industries, which can help to diversify their portfolio and reduce risk. Additionally, ETFs typically offer low fees and expenses compared to actively managed funds, making them a cost-effective way to invest in the stock market. When selecting a dividend-paying ETF, it's important to consider factors such as the fund's investment strategy, the composition of the underlying stocks, and the historical performance of the fund. By carefully evaluating your options and selecting a high-quality dividend-paying ETF, you can build a well-diversified portfolio that offers a reliable source of income and long-term growth potential. Be patient. Dividend investing is a long-term strategy, and it may take time to see significant returns. Stay patient and stick to your investment plan. Even during market downturns, patience is a key virtue in dividend investing. Unlike other investment strategies, dividend investing is focused on generating income through regular dividend payments, which can take time to accumulate and grow. It's important for investors to have a long-term mindset and be patient when investing in dividend stocks, as it may take several years for the investments to generate meaningful income. Additionally, dividend stocks may not experience rapid price appreciation like growth stocks, but they can provide steady returns over time. By investing in high-quality dividend stocks and reinvesting dividends over the long term, investors can generate significant returns and build a reliable source of income. Avoid overtrading. Don't try to time the market or make frequent trades based on short-term market fluctuations. This can lead to costly mistakes and erode your returns over time. Overtrading, or excessive buying and selling of stocks, is a common mistake that many investors make, particularly those who are new to investing. While it may be tempting to try to capitalize on short-term market fluctuations or news events, overtrading can lead to a portfolio that is overly concentrated in a particular area or asset class, which can expose investors to unnecessary risk. Additionally, overtrading can lead to higher trading fees and taxes, which can eat into your investment returns over time. It's important for investors to develop a disciplined, long-term investment strategy and avoid the temptation to make frequent trades based on short-term market movements. By focusing on high-quality, well-diversified investments and holding them over the long term, investors can generate steady returns and minimize their risk of loss. Avoiding overtrading is a critical component of successful investing and can help you to achieve your financial goals over time. Seek professional advice. If you're new to dividend investing, consider seeking the advice of a financial professional. They can help you create a personalized investment plan that aligns with your goals and risk tolerance. Professional financial advice can be a valuable resource for investors seeking to maximize their dividend returns. Financial advisors can provide guidance on selecting high-quality dividend-paying stocks, creating a diversified portfolio, and managing risk. They can also help investors to evaluate their investment goals, risk tolerance, and overall financial situation to develop a customized investment strategy that aligns with their unique needs and objectives. Additionally, financial advisors can offer insights into market trends and provide guidance on how to adjust your investment strategy based on changing economic conditions or other external factors. While it's important to do your own research and maintain an independent perspective, seeking out professional advice can help investors to make more informed decisions and achieve better long-term results. Whether you're a seasoned investor or just starting out, working with a financial advisor can be a smart investment in your financial future.